GGV has been making the argument already that there's a valuation floor in software, arguing if valuations fall too low, there would actually be buyouts exactly like we're seeing with Anaplan. Glenn, it's great to have you this morning. I guess the question, though, is if we see more, will private equity firms be successful? Is this an issue of companies, less not being well run and more, markets valuing them on a more normal historical basis? Is there room for them to create value?
First off, a lot of these companies are doing exceptionally well. Anaplan, no exception. The company's growing 30% plus year on year, very strong margins, so an attractive asset. And now you have Thoma Bravo coming in and paying, yes, 11 times forward for the asset, more like 14 times next 12 months, which is actually a huge premium to where the current cloud index is trading, more like 7 or 8 times. So nearly double what you're seeing the average SaaS multiple these days. So I actually think this is a harbinger of things to come. In fact, I've chatted with some of my friends in the M&A space who tell me that this is the first of many deals that are coming. There's a lot of others that are being discussed at the moment. And you have both private equity and strategics looking at these assets and licking their chops.
So if investors want to look for the next, say, Anaplan, another potential target, what should they be looking for? As John sort of laid out, there's a lot of different views towards valuations and where they should ultimately settle.
I think first off, you look for growth. And you're going to see growth across many, many different areas of software right now, whether it be security, cloud infrastructure, SMB tech. There's just growth almost wherever you look. So that's the first thing. Second thing I'd say is margin structure. And a lot of these companies trade at very high margins. That attracts PE. And the third thing, and public investors have caught on to this, looking at retention rates. So gross retention and net dollar retention are huge and important with respect to the lifetime value of software. And a lot of these companies are showing very high margin and also excellent retention rates, with net dollar retention rates in the 115, 120, even 130 range. And that just means that dollars gained today are going to be worth more in the future. And I think that's why private equity and strategics are excited about this asset class.
Glenn, I wonder, is any part of their calculus the idea that there can be better cost control, better cost discipline? And if so, how are they going to do that in ways that the company couldn't do on its own?
Yeah, I think for the Thoma Bravos and Vista equity partners of the world, there is part of the story is cost containment and also consolidation. Oftentimes they'll buy assets and then, as John mentioned earlier, they'll continue to add other assets and grow a bigger company that way. But really, the name of the game these days is not so much about cutting costs. It's about not investing as aggressively in the next leg of growth. So I don't think you're going to see massive layoffs at these businesses. In fact, in software, one of the challenges is right now, there's just a labor shortage. And no matter where you go around the world, and these companies are all sourcing labor outside the US, it's just every market is getting more and more expensive to hire people and retain them. And with stock prices down, equity as a component of people's compensation is going lower. So I actually think you're going to see expenses continue to stay steady or even rise at the average software company because of that. But it doesn't really change the fundamental picture in my mind. Margins are super high, retention rates are high, and growth is high. That ultimately leads to great long-term value.